I know a lot of people have been reaching out, asking sort of how to invest, how do you learn, how can you make just a little bit of money every once in a while. I'm going to kind of show you what I've been doing for the last month and a half to sort of help me make a little bit of side money to sort of help pay for gas because gas is crazy right now. So first off, I would recommend getting Robinhood. Using Robinhood is the best app. It's the easiest app. It's the app that dumbs everything down, makes everything so much more simpler. So this is the one I would use. And when you log in, I would go ahead and recommend buying Robinhood Gold. It's $5 a month. It's not that much money, or you can pay yearly, which is $50. That's literally no money at all. It's barely anything, and it's going to give you so much more stuff, and your interest rate is literally going to pay for it itself. So however much money you have in there just sitting, waiting, it's going to pay you for that money. So right now I have a lot waiting because I am waiting for a crash to happen. So I have about 15,000 invested currently. After tomorrow it'll be 5,000 because one of my contracts is going to be released. I'll explain how that works in just a second. But basically, currently this is what I got, and this is sort of the interest that it's making on this right here. And let's see here. So down here you can see obviously lifetime interest paid about $200. So it's paid me about $200 to have this money just sitting in there. And I believe I started this 2 months ago. So I've made about $100 a month, just in interest by itself. So it definitely helps, and it's definitely good to have. And why have a ton of money in your bank? Obviously have money in your bank just for quick purchases, but why have a ton of money in your bank when you can just do this and make interest on it, because your bank's not going to give you anything. But whenever you sign up and get Robinhood Gold, you can then click over here to deposit, and let's just put 2,000 in there, transfer 2,000, and then watch what happens. So when you have Robinhood Gold, this is not without Robinhood Gold. I think it's up to 1,000 that you can use that they give you for free. But whenever you transfer money, it takes a few days for it to settle, right? So it'll take 4 to 5 days for this to settle. But I have Robinhood Gold, so even though it says July 8th, right? It's gonna take that long for it to get there. But Robinhood Gold, instant deposit funds. It's going to give me so pretty much Robinhood's going to give me $2,000 of their money, and then whenever my money comes in, it's just going to go straight to them. So they're going to give me $2,000 instantly to be able to use. So boom, there we go, $2,000 in there, just dropped it in there. So then they're going to give it to me instantly. I don't have to wait. That's another reason why it's good. So now that you have your money in here, I would recommend, you can start off with any amount of money, but obviously the more money you put in there, the more it'll help. So let's just go over here to Robinhood and kind of explain what I do and how I make a little bit of money every single week. And even if it doesn't work, I'll show you how to actually make money off the back end. So first off, I use Robinhood because I believe in Robinhood. I'm very bullish on Robinhood. I believe it's going to go straight to the moon, and I believe it has a lot to go. Now, like I said, I also believe that there's going to be a major stock market crash within the next year or so. That's why I have a lot of capital sitting on the side. Okay, but I'm still going to do this every single week to make reoccurring money because I'm only risking a little bit of my portfolio to make money every single week. So this is definitely good and something that you can do to make that little bit of reoccurring revenue. And then whenever the stock market does crash and it does drop, then you have the rest of your money to throw in for long-term investing. So right now I'm options trading, which is more short-term. Then when the stock market crashes, I can long-term. Even though when it does crash, I'm still going to do. There's a lot of different ways you can do options, and I'm going to explain them all. But whenever you do an option, you can short-term option, you can mid-term option, you can long-term option. You can pick sort of how long you want to separate each of them out, and I'll show you that in just a second as well. I do weekly, just because I think there's going to be a stock market crash soon. Most professionals, and I will be doing this whenever the stock market does crash and stocks are sort of priced how they should be, because right now all these stocks are overvalued. Every single stock in the stock market is overvalued like crazy. So when it does drop, I will then be returning to the professional way of doing it, which is monthly or every 2 month option trading, because it's a lot less, I guess you could say, risk, and you get a lot of upside while still being able to carry out a lot of your money and having a lot of that money there to use. So we'll just go ahead and start. So if you don't have a lot of capital, say, to be able to do this, you want to throw in enough money to where you can buy 100 shares of whatever you want to do. So for example, I option share Robinhood, meaning I have to have at least $10,000 available. Well, at the time it was at $100. Right now it's at 107. So I'd have to have $10,700 to use. But at the time it was at like $98. So I needed $10,000 to be able to use to option trade. If you scroll down here to SoFi, you can see SoFi is only at $18.39. So you only need like a little under 2 grand to be able to option trade SoFi and still make reoccurring weekly revenue that could be up to $50 a week that you can get for free. And listen, it may not be this big. You see all this stuff on Instagram. All these day trading kids making all this money. Don't listen to that. It's fake. They're just trying to sell you courses and stuff like that. That's how they're making their money, is off courses, off Discords. They're not making their money off day trading. If you can look it up right now. Most day traders, over 95% of every day trader ever is down in money. So they've actually lost money. You are betting against, or you're not betting against, but you're playing against multi-trillion-dollar companies. Day trading is just not for regular everyday citizens. It's not. Options trading is, because you can make a reoccurring revenue, and when day trading, if something goes wrong, well, you're done. I mean, that's it. You don't get any redos, you don't get any whatever, but you can make good upside from it. Whereas option trading, there's many ways where you can reverse and win in the end. And like I like to say a lot, I like to tell a lot of people, this is not financial advice. I'm not a financial advisor. So obviously do your own research, do your own thing. I'm just saying that for, legal reasons. But options trading, if you really think about it, you can't lose. Because if you have patience, you won't be able to lose, because it's a long-term game and it's also a short-term game. I play it short-term, and if I mess up, then I have to play it long-term. Either way, I don't lose. It's just patience. That's all it is. And so I'm still actually trying to learn patience as I do this. And nobody can ever master patience. It's impossible. But anyways, say you don't have, $10,000 or so to use on Robinhood, which I wouldn't use 100% of your account anyways. Say you just got 2 grand or 4 grand or something. And so you can go to SoFi, which I'm going to use Robinhood for example, because I do Robinhood. So, if you have $10,000, great. I'll recommend a little bit more if you're going to want to do Robinhood, because they're a little bit more pricey. But for example, I'm going to go here, and as we can see today, I've made about $800 off Robinhood. So that's pretty good. My average cost is about 99. It was 46, but I'm going to explain how it got so high. So I'm going to go over here to Trade Hood Options, and on your phone it's the same thing. It'll say the same thing. And I'm going to sell a put. All right. And this is where you get to pick the day. So if you go out way later in the date, you make a lot more money, but you have to wait a lot longer. And your decay, which is like your time value, pretty much. And I'll sort of explain what that is, but I don't want to confuse anyone, because most people watching this video don't really know anything of what I'm talking about. So I don't want to dive too deep and just confuse your brain. You're gonna have to do your own research. You're gonna have to look into it yourself. I'm just sort of explaining the basics so you can understand how it works. But basically, you don't really want to go, again, I weekly options trade. So by next week, pretty much what I'm going to say is, okay, I'm going to guess that Robinhood is not going to go under $100. If I guess this right, they're going to give me $134 off the rip. So I get this money now. And when they give me this money, I get to keep it. I only lose it if Robinhood goes under $98, because they're going to give me 134. So, they're kind of evening out. That's the break even. But you're going to start losing money at 100, because that's what I'm guessing the stock's not going to go down to. So, by this time next week, which I'll do one of these tomorrow after my contract expires, Monday after my contract expires, and I get the 10K released for collateral. So I'm going to go to Robinhood and I'm going to say, okay, I think that Robinhood's not going to go to 102. So you look over here and you see chance of profit. Don't pay attention to that. Pay attention to it, but don't at the same time, because anything can happen in the stock market. So really, they don't know if that's your chance of profit, because they're not factoring in future. They're just factoring in the past. But you really want to look at your delta, right? So delta is around 25. That's perfect. You want to be between 20 and 30. And really what that is delta is your chance of making profit, but that's factoring in just regular stock market swings. You also want to look at implied volatility. It's about 66% right now, which is actually pretty low with how Robinhood's been lately. It's usually around 80, 90. The more implied volatility, the more money you're actually going to be given when you do these trades. So, it can be good, but at the same time, it's very volatile, so it can swing very fast. A lot of people say you want to look for around 50. You can go for 66. That's fine. I mean, I've been selling Robinhood for the past almost month and a half, 2 months. Oh, actually 2 months now. And, Robinhood's done great for me. So You want to look for a delta between 20 and 30. This one's 25, so this one would be perfect. So, if this was Monday and my collateral was released, I would look at this and I would say, okay, this looks good. I think I might want to do this. So all I have to do, it's not going down. Okay, there we go. So all I'll have to do is I just look at this 102. There's a 76% chance of profit, which remember, you want to look at this delta. So I'd click this plus. They're now going to give me $172 to make this options trade. So they're going to give me $172 to bet that the price will not go below $102. My break even is 100 because remember, you have to factor in the 172 that they give you to make this. Now, this is weekly. Most pros, most gurus out there, they do 30 days, but I think there's going to be a stock market crash soon. So I'm doing weekly because I want to play it weekly, not monthly. Monthly is too long if I think long term is bearish. I'm playing weekly because I want to make weekly reoccurring revenue. And I don't want to get stuck in something for months when I can just get stuck in something for a week or so. So, but you do make more in the long run, and you have more time to play with it, and you have more time to, look into it. Your chance of profits are lower because it's later out in time. But again, I just like doing weekly for right now until stock market crash happens. So, if I did that trade right there, so let's say that I win, right? If the stock stays above 100, I just get to keep 172. So basically, in 1 week, I got paid $172. Let's do a little bit of multiplication here. So in 1 week, I got $172. Times that by 4, that's $688 a month that you're getting. That's a car payment. That's a big car payment plus insurance. So you could pay off your car and your insurance for your car every month just based off doing this every month. Now, you're not going to win, obviously. But in the end, it's going to come out around the same because I'm going to show you what you do if you lose, which I did last week, and I'm going to show you how I ended up winning in the long run by losing, which sounds crazy, but I lost, and that loss made me win. Again, I'll explain in just a second. So if the stock stays above 100, 102, I get to keep $172. So they're just going to give it to me. I just get to keep it. But, I won't have to have the risk of buying 100 shares. Now, if the stock goes below $100, below $102, I then have to buy 100 shares of whatever company I'm doing. So for example, it's Robinhood. So I did an option trade and I had bet that it wasn't going to go under $100. And it was actually funny because the stock was right at 108 like last week. And then I bet that it wasn't going to go under 100 and it did. Like 2 days before that the contract was supposed to expire. But I wasn't mad because I knew what I was going to be able to do after, which I'll show you again. Excuse me. So it goes under, you have to buy 100 shares of the stock. Well, okay, now that you've bought 100 shares of the stock, you can now do a covered call, which means now that you have 100 shares of this company, you own 100 shares of this company. So you are part of this company. That's what investing is. You're part of a company. So now you can sell covered calls. So this is basically, you're guessing that the price isn't going to go above what you think it is. So again, I lost, and I had bought 100 shares of the company at $100. So pretend it was right here. I'm just going to go based off what I did. And then I had guessed, whenever I lost that, I said, you know what? I want to get out of this quick because I want my collateral to be released before August. And so I was like, you know what? I'm just going to go for 103. I could have gone higher. I could have gone for 107, and I would have made a boatload of money, right? But I didn't because I like to also manage my risk. I like to keep my risk small while still actually making profit in the end. So I went for the 103. Now, I didn't get paid $700 to do this, but again, you're guessing that the stock isn't going to go down. So let's just use one of these to make it easier. So say I had to buy Robinhood at $107 a share, which is what it's at right now. So I had to buy $10,700 worth of this stock. So I look at this and I say, okay, well, now that I have 100 shares at $107, now I can sell covered calls. You cannot do this unless you own 100 shares of the company. If you do not own 100 shares of the company, you cannot do this. So again, you have to own the company to do this. So I'm looking at 107. I'm saying, okay, I don't think the price by next week is going to go to 112. There's no way it goes to 112. So I'm going to click over here, and they're going to pay me $300 to bet that the stock is not going to go down to go up to 112. So I'm betting that the stock is not going to go up. If it doesn't go up, if it stays under 112, I get to keep $300. So they're literally going to pay me $300 for keeping it under there. Now I may lose money because the stock's obviously going to go down, and 100 shares is a lot, but it's the long-term game if you're selling covered calls. Because if you get assigned 100 shares, you can just sit here and keep selling covered calls all day, and in a year, $300 a week, right? Let's just say $300 a week times 52. You're making $15,600 off the back end, off doing nothing, just selling covered calls. Now the stock may fall and you may lose 10,000, but in a year or 2 years it's going to go back up again. So you've made $15,600, and then once one of these fails and it does go above what you think it is, you still get to keep all that money that you've made, plus all the profit that you made from the stock actually going up. So if you think, okay, I don't think the stock's going to go up to 120, I think it may hit 116, but I don't think it's going to hit 120, you're still going to get paid $113. And here's the good part. Since I bought the stock at $107, I'm going to make from 107 all the way to 120. I'm going to make all that money in between. So anytime that the stock raises under $120, I get to keep all of that money. So I will show you later in my position how I did it. So not only are you getting paid $113, but you're actually getting paid all of it as it rises. Now, if it goes over, again, you're not actually losing $500. So they're not going to take $500 out of your account. They're just showing you what you could have made. So if the stock goes to 126, from 121 to 126, I could have made $500. But instead, I bet that the stock wouldn't go above 120, and I didn't get it right. So, I don't lose $500. I actually am going to gain from 107 to 120, which would be like over $2,000. And I don't lose this $500. It's just money that I could have made that I won't get to make. Because if you do fail this and you don't pass, if you don't get it right and it's above 120, which I'll show you my position, then they're actually just going to sell your shares for whatever you guess. So let's go to my position and I'll show you. So for example, right, I bet that the stock was not going to go to 103. It was at 100 at the moment. So they paid me, I think it was $170 something dollars. We can actually see it. So they paid me $174 right here to bet that the stock, when it was actually at like 95 at this time, because it went down so much yesterday. So I had bet that it was not going to go to 103. Well, it did. It went to 107. So again, I didn't lose $459. I didn't lose that money. That's just money that I could have made that I now don't get to make because I have to sell my shares at 103. If the price goes above what you bet it was going to be at, you have to sell those shares at $103. So whenever I sell my shares tomorrow, because it'll automatically do it for me, they're going to sell them at $103. Even though the stock is at 107, they have to sell them at 103 because that's what I bet it wouldn't go up. But here's the good thing. I made money from this because when I bought it about $99. So I made from 99 to 103. So I made about $500 off of just a $4 swing on the share. So not only did I make $400, but they paid me $174 to actually do this. So I made $574, and I didn't lose this. So I don't have to subtract this from anything. It's just gains that I could have made. So if I'd never even did this in the first place, I would have made, minus this 174, I would have made $400 plus $459, so $859. Would I have made more money? Yes, but you have a lot bigger risk owning 100 shares rather than just sort of, I guess you could say, lending them off to somebody else. So again, I'm going to get paid weekly for this. Well, now that I have to sell them, I won't, but I'm just going to do it again. It's just a recycle. You just do it over and over and over again, and it's a strategy. It's what you do. So I'm going to have to sell tomorrow my shares for $103 per share, but I'm going to make from 99 to 103. I'm going to make that money that I made, and then they're going to give me the 174. And then again, I don't have to pay this at all. This is not money I have to pay. It's just money I could have made that I didn't get to make. But that doesn't matter to me. I made $574, so why would I care? Yeah, an extra $500 would be great, but that comes with a lot more risk because if this stock would have gone down, I would have still got paid $174, and in a year or so, it would have actually gone up well over 107. So in the end, again, you will not lose money long term. If this is long term over years and years and years, you will come out on top every single time if you just use the same strategy, which is what I've learned and what I've done. And I've been doing this for about a month and a half, and it's turned out really well for me. So, and I've just been doing Robinhood over and over again. So, I would sort of recommend doing this, honestly. I mean, it's good upside. I mean, I guess that's really it. That's sort of what people wanted to know. I mean, there's a lot more to investing, obviously, and there's a lot more to options trading too. But this was just sort of, and a lot of people wanting to know, well, how can I make an extra $50 a week? Or in my case, an extra $150 a week. Well, this is how. This is how you can do it. Um, you're not, yes, you're risking money, but you're risking it long term. So again, if you have to buy 100 shares of the company, that's cool. The company is going to go back up eventually. It's going to go back up. I mean, it's the stock market. It's going to go up eventually. It's just a matter of when. But until it gets to that point, you can just sell covered calls and you can still make weekly reoccurring revenue. So either way, win or lose, you're still making weekly reoccurring revenue. That 10 grand that you put aside may fluctuate a lot, but again, over the span of a year, selling covered calls, I could make $3,000, and then the stock could finally get to where I can sell it, whether it's I break even or I sell it for more than I bought it for, and I come out on top. So um, so it's definitely a good way to make money, and I would definitely look into maybe doing it. If you don't have the capital to sort of do $100 share, do SoFi. It's only at $18 right now. You could do SoFi so easily. I mean, watch. I go to trade SoFi. I can sell a put, and you're not going to make as much money because you don't have as much money to risk, but any money really counts. So 76%, the delta is at 26, that's pretty good. Let's look at 18, the delta is at 37, that's too high. So we can go here, say you have $4,000 to use, you're going to make $26. It is what it is. That's gas for the week. Well, and I drive a Honda, so that's gas for me for a week. I can go to continue and I can say, I don't want one contract, I want three. So say you can only risk, $6,000. Yeah, $5,000. Well, you're going to get paid $78 and you're going to risk 5,000. And if you lose, then you can just sell covered calls against it and wait till it goes back up. So, there's plenty of ways you can do this, and there's obviously you can do many of these. Like you can buy a call. Let me go back and unclick this. So you can buy a call. The money's gonna, or the stock's gonna go up to $20. Well, if it goes up to $20, every time it goes up after that, you just make money. But obviously that's not very smart, and you can do the same below. You could risk $120, but you could make unlimited technically, but if it goes up to 20, you can make $60. So there's a lot of different things you can do, but most everyone when they're doing options is selling puts and selling calls. You're selling a put when you bet that the stock is not going to go down any, and you're selling a put when you bet that the stock is not going to go up any, or at least to whatever strike price you do. So hopefully this helps you out, and hopefully you can sort of see how to make a little bit of reoccurring revenue weekly, and you can really, really help yourself out, whether it's gas, groceries, bills, whatever it is. I hope this sort of helps you out. And if you have any questions, you can obviously ask. I'm down to answer any questions. And I think that was it.